Hi, everybody, and welcome again back to our fifth and final webinar for the Wealth Summit bonus. And we are not going to be starting yet. We have a few people that are still coming on, so we'll be starting shortly in about 2 or 3 minutes. So just bear with us, and we'll be checking in. So we'll check back in just a few minutes. David, are you ready to start?
Yeah, I think we can go ahead and get started.
Okay, great.
So welcome everybody. Thanks for joining today. As Jen said, today is our fifth and final installment of small business pension plans, and it's on the topic of non-qualified deferred compensation plans, abbreviated as NQDC plans. Now this is kind of a fun webinar because non-qualified deferred compensation plans are not subject to all the rules that your 401ks and things like that are, so it can lead to some pretty interesting plans. So just to kind of recap here, we started session one all those months ago, just kind of an overview of pension plans for businesses. We talked about the safe harbor solo 401k, sort of the baby step building block of a pension plan. Then we moved into advanced retirement plan design, where we're learning to skew some of the benefits towards the owners or key employees. And then last session, we talked about defined benefit pension plans, the cash balance plan, and how for those businesses with a lot of excess money can really put some tax deferred funds away. Now today, we're going to talk about the non-qualified deferred compensation plans. And here's my little graphic. Once again, you'll see that everything lines up nicely in this little organizational chart. And then up here on the top right, we have non-qualified deferred compensation because it's kind of out there on its own. It is a type of a pension plan, but it's really sort of a hybrid and it kind of sits out there. So believe it or not, if you've stuck with me the whole time, we've covered all these different topics. And we're going to wrap up today with what exactly is a non-qualified deferred compensation plan. It is actually any arrangement between an employer and an employee to pay compensation at a later date. That's it. It's pretty simple. It's, hey, John, you've been a great employee here. Realize that you don't want the compensation today, but you'd like it in the future. So we're going to write up this agreement to pay you in the future. That's all it is. It doesn't provide the tax benefits under IRC section 401A. Basically what it means is it's not a tax favored plan. You use it to reward highly compensated or key employees. It's not something that you're going to roll out for your entire employees and staff. Non-discrimination rules do not apply. So you can pick and choose whoever you want to be the beneficiary of this type of plan. There's nobody in the IRS is going to come in and say, oh, you discriminated against this person or that person. Obviously, let me take that back so you don't get the wrong impression. You can't discriminate based on, race, creed, religion, those type of things. I'm talking about what people make or the position they have in your company. I think that's kind of obvious, but since this is being recorded, I just want to make sure that that's very clear. Okay, so the way the deduction works is on a deferred compensation plan, the deduction for the employer is recognized in the year that the employee recognizes the income and pays the tax. So there's really not a lot of tax implications. We'll talk about the tax implications in detail later, but that's kind of the basic rule. So what's in a name? Because there's such a wide variety of these type of plans, you can call it, anything you want. These are some of the more common names that you'll hear. If you hear these, what they're really talking about in the background is a non-qualified deferred comp plan. So salary reduction arrangements, bonus deferrals, top hat plans, SERP plans, as opposed to SEP plans. This is the Supplemental Executive Retirement Plan, Excess Benefit Plan, One of my favorites, the phantom stock plan. Section 457 plans and rabbi trust. We'll get into rabbi trust in a little bit. It's a really fascinating story of how those came about, but they're all different types of names. You could come up with a non-deferred comp plan for your company, and you could call it, you know, the BlueSky future retirement income plan, or, you know, whatever you wanted to. There's no set. I mean, you're going to hear that throughout this presentation. There's no set way of doing this. There are some basic rules that you have to follow that we'll get into, but you generally do those to make it more advantageous to you or the employees, but essentially there's really not a lot of rules. So some of the advantages, talked about this, can be discriminatory based on what people make or the job they have or whatever. They're generally not regulated by ERISA. That's the Employee Retirement Income Security Act, sort of the act, I can't remember, it was like 1973 or so, that started all this concept of qualified retirement plans. The Department of Labor and the IRS have very little to say about what you can and can't do in your plan. You can create customized and unlimited benefits. Of course, you have to be able to afford them, but you could literally say, look, Mary, you've been working here for, you know, you've been a great employee, and so we're going to set up a deferred compensation plan, and when you're 65, we're going to pay you $6.2 million a year, and that's fine. Now, whether you can actually fulfill that or not, that's another question, but the point is that you can offer unlimited benefits. You probably won't want to do that from a HR and you know, lawsuit standpoint, but the reality is there's no limit like there are with the 401ks and limiting you to 25,000 or 19,000, 25,000 deferral, you know, 56,000, 62,000 limits overall. One of the other advantages from the company standpoint is it can be forfeited. So if the employee doesn't follow the rules that you set forth, then they forfeit it. So for Mary, that you're promising, you know, $6.2 million a year, you could put a clause in there that says, oh, and by the way, by the time you retire, you have to have helped us be successful, and we have to be making $50 million a year, or you don't get your benefit. It's forfeited. So that's one of the advantages to the company, is you can put conditions on it that allow it to be forfeited. Of course, the benefit to the employee is the deferral of tax until the benefits are received. So that $6.2 million you promised to Mary, she doesn't pay tax on it until you actually give it to her. So that's the benefit for the employee. Some of the disadvantages, kind of the flip side of the advantage of the tax deferral for the employee, is for the employer, there's no current income tax deduction for the liability or the expense that you promise someone those benefits for. So if you're making a promise for future compensation for somebody, you don't get a current deduction for that as the business owner. For the employee, we'll talk about this, the security of future benefits. They do not have to fund the non-qualified deferred compensation plan. And as the employer, you may think that's an advantage. Hey, I can just promise this and I don't have to fund it. In fact, if it is funded, then it's subject to some additional rules and it gets complicated. Generally, you're going to want your plan to be unfunded. So disadvantage, of course, for the employee is risk of forfeiture. Is if you don't follow the rules and do everything you're supposed to, you may not get it. There are no rollovers available. This is not a 401k. This is not something you roll into an IRA or roll into any type of account. It's paid out to you, and then you can do whatever you want with it. It is subject to Social Security and Medicare payroll taxes upon receipt. So it is considered compensation, hence the name Non-Qualified Deferred Compensation Plan. Yeah, and this is the old pension plans where people, they need some money, just go rob a bank, right? So we don't want our employees doing that. So this can be a valuable benefit for them in the future. Some common features of a non-qualified deferred comp plan. Some of these are similar except for the forfeiture, the vesting and distribution, similar to a 401k. You can have vesting where you promise this benefit, but it only vests after a certain number of years. 3 to 5 years is very common in that. If the employee, and I say big if the employee is making contributions of their own money, typically that vesting is immediate. And we'll talk about the isolated cases where a company can do that. Some forfeiture provisions, very common, is you can put a non-compete in there, and if the person quits your company and starts competing, they don't get it. Obviously, misconduct, lack of cooperation, not meeting goals, and of course, if they leave the company, that's the big one. You have this plan, you're trying to retain good employees, so if they leave, obviously you can put provisions in there that they have to forfeit it. Typically, there's not going to be a forfeiture of employee contributions. Distribution options, similar here. You can pay out a lump sum. You can set up an annuity or a term of years. This is very typical that the plan will be paid out over a number of years. Once it vests or at retirement, however you set it up, that you pay it out to the employee over a number of years. And then a lot of times we'll also build in a change in control option. So if the company is sold or change in ownership or control of the company, that it gets paid out. And the reason for that is, if you recall, I mentioned briefly, we'll talk about this in a little bit, is generally these plans are unfunded. And so if you have an unfunded plan and you change ownership or the company gets sold, the employee is, could be left out in the cold. So typically we'll build a change of control distribution option into the plan. Okay, let's talk about elective versus non-elective. So an elective plan is one that's initiated by the employee, meaning the plan is there and they have the ability to defer money into it. You see this, we have a couple clients working for, there are several large companies that have this, and you can elect to participate. So if you're making, if your normal salary is, $300,000 a year, you can elect to defer some of that, maybe $50,000 into some sort of a plan. Those are a lot of times going to be your funded plans, but there are elective plans. More typical is a non-elective plan where the employee does not elect to participate. It's sort of a benefit given to them. What we call a golden handcuff plan is where you structure it so that you're trying to keep the person from leaving. And if they leave, they lose that benefit, and does not result in a reduction of the employee's current compensation. The elective plan is typically your pay is set and the employee elects to defer some of that. Okay, here's a big one. Unfunded or unfunded. A funded plan is where the employer actually places money aside for the benefit of the employee using a trust or escrow account or something like that. And a typical example of this is a rabbi trust. And we'll talk about a rabbi trust in a minute. An unfunded plan is where the assets used to pay the obligations come from the employer's general funds and are subject to the creditors. And so at no time are there any specific assets set aside for the employee. So there's no account with the employee's name on it. The rabbi trust, while it's funded for the purposes of our slideshow here today, in the legal world, it's sort of an unfunded plan, which gives its tax benefit. But suffice to say, you can have a funded or unfunded plan. Typically, unfunded is good. The tax advantages of an unfunded plan, the employee doesn't get taxed on the compensation if it's unfunded. If the employee has a beneficial interest in the funds, then the benefit is taxable. And it goes back to the economic benefit doctrine. And if the assets are unconditionally, irrevocably transferred as compensation for their benefit, then it is taxable for them. So even if, and this is where the rabbi trust comes in, is even if there's money set aside, notionally on a piece of paper with someone's name beside it, it's still subject to creditors, and so that makes it technically unfunded. So it's a little confusing. So let's delve into that a little bit more. The rabbi trust. The company sets up an irrevocable grant or trust for the purpose of holding contributions. So let's say you have an employee and you have a plan set up and you say, hey, I'm going to put $10,000 a year aside for you for retirement into this non-qualified plan. If you set up a rabbi trust, you would actually put money into that trust. And this provides some security to the employee that the compensation will be paid at some point in the future. And the employer, and here's the key, can't divert the funds for other purposes. If it's completely unfunded, you could have the same thing. You could say, hey, at some point in the future, we're going to pay you $10,000 and not actually set the money aside. Well, that's no assurance that you can pay it. And you could decide, 2 years from now that you wanted to use that money to renovate your office or something like that. So a rabbi trust prevents that, and it's actually set aside. But the way these are set up is that the trust must subject the trust assets to claim by creditors. So this is how we avoid taxation of the employees. The trust says, well, the company can't use it for whatever they want. It has to be set aside for the employee. But if the company files bankruptcy or they owe, a supplier money for materials or whatever, that the trust assets can be used to satisfy a creditor. It's just that the employer can't use it for whatever they want. It's a very important tool, and it's named after the legal case where a rabbi set up in the synagogue. He set up a plan like this, and he set up money in a trust according to these, and the IRS took him to court, and he won. And so these things became known as rabbi trusts. If you ever hear that term, that's where that name comes from. Okay, so here the severance package, run in the room, grab everything that you can get. This is kind of like a non-qualified deferred comp plan. You could tell someone that, hey, 10 years from now when you retire, we're going to open up the stock room and you can grab whatever you want. This is actually an example of a non-qualified deferred comp plan. It can be just about whatever you want. Now, the employee would pay tax on whatever he grabbed and put in his shopping cart, but that's kind of a funny example to show you how the rules are very flexible. Okay, let's delve into a couple of specific types of plans. Number one is what we call a Section 457 plan. Now, I point this out because this is probably the most well-known deferred compensation plan that people hear about or that you read about. However, it's generally only available to employees of state or local governments and tax-exempt organizations. You can't have a Section 457 plan in a taxable corporation. A 457A there you see in the bottom right corner, only for non-qualified for-profit entities. It's very, very uncommon. The other reason, I guess, kind of selfishly I point this out, is it's really unfair that companies can't set these up, because the Section 457 plan works as a second, like a second 401k, and that they can defer the maximum into this plan and a 401k or 403b. In fact, at Carolina East, where I'm on the board and run the investment committee, we set one of these up. And so we have doctors that are deferring, like 90-some thousand dollars a year between their 403b, their 457, and their money purchase pension plan. So anyway, I like to point this out. Most of the people on this call, you're not going to be able to set one of these up, but you may hear about them and wonder why you can't get it. And it functions almost like a 401k. Is you put money in, you get to pick investments, it grows, and so forth and so on. This next example, we're going to talk about the phantom stock. This is actually what our example is going to be. So out of all the different types of non-qualified deferred comp plans, this is the one that I chose for our example today. It can be a really neat thing to implement in your company if you're trying to retain key employees, or if you're an LLC or S Corp. It becomes a little bit more difficult to award actual stock. you know, if you're Google or Apple or Coke or whatever, it's easy to issue shares in your company. They're publicly traded, and as a C corp, and to have stock options and restricted stock and all those things you read about. With an S corp or an LLC, sort of your small business structures, issuing stock options becomes really cumbersome. And not only that, because it's a pass-through entity, giving actual shares to people, while you may want to bring in another owner and actually have them shares, a lot of times they're not really interested in that. In fact, it can mess up their taxes. As you probably know, there are certain benefits that greater than 2% shareholders of an S corp are not eligible for, and you got to deal with estimated taxes and all those sorts of things. So sometimes employees don't actually want physical stock anyway, and it becomes cumbersome. You know, if you borrow money, say you're buying a building and you borrow money, well, the bank's going to want to see the tax returns of every owner. You know, they're going to want to, you know, it becomes very cumbersome for a small company. So phantom stock is a great way to reward those key employees that you want to by crediting a number of shares to someone's account without actually transferring the ownership. Okay, so like it says here, you credit a specific number of notional shares to an employee's account. So you say, look, Sally, thank you so much for your loyal service. You're someone that we really want to keep here. So, you know, our company is worth, you know, 5 million shares, and we have 10,000 shares outstanding. So $500 per share. So we're going to grant you 100 shares of notional stock, or basically $50,000 worth. And you keep track of that on a piece of paper, and the value, you know, spreadsheet, whatever, and the value goes up and down over time. At some point in your plan, whether it be, you could have them vest in 5 years, in 10 years, when they're 65, however you want to do it, at some point when the shares are vested, the employee reports compensation equal to the fair market value of the shares that were credited. And we'll talk about the differences in the two. That would be a full value or an appreciation in the value of the shares since the date where shares were credited. And so sometimes you're going to credit the full value of the shares. In the little example I gave, it would be $50,000 plus any appreciation in the value of the company when it vests, or a stock appreciation right. They just get the increase in value of the shares. So if it went up from 50,000 to 100,000, you would just give them the increase in value. And so that's how phantom stock works. Much simpler to run and administer as opposed to actual grants of stock. A lot less paperwork, a lot easier conceptually for people to understand, and the taxation of it is relatively straightforward. So speaking of taxation, let's talk about that. We've mentioned this as we've gone through, but let's zero in on it specifically. The employee is taxed when the compensation is received, either cash or other property. The little shopping cart example that we saw, the guy in the storeroom, is received not when the compensation is deferred. And so the flip side of that rule is the employer is entitled to a tax deduction in the year when the employee recognized the income. It's that concept of income matching. Is the employee is reporting income, then the employer gets to take a deduction. You'll hear a concept, very important concept, called constructive receipt. So constructive receipt is that time when the employee has to pay tax on it. And the income is considered constructively received when it's set aside or credited to a participant. Okay, so if you had a plan and you credited the employee with a certain amount of money and there were no restrictions and no time limits to that, that's not non-qualified deferred comp. That's just pay. I mean, they can immediately avail themselves to it. And so they would be taxed on that income immediately. So the point is that it's not constructively received if taxpayers' control of the receipt is subject to substantial limitations or restrictions, meaning For example, hey, you have to work here for 5 years, or you have to help us increase our revenue by 25%, or you have to be 65, or something like that, then it's not constructively received. And I think that makes sense. There has to be substantial risk of forfeiture. This is another component to it, is that the risk of forfeiture can't be insubstantial. There has to be some sort of future services that they have to provide, or certain benchmarks or something like that. And you'll notice there, the second bullet point, just having a non-compete agreement is not considered substantial risk of forfeiture. And if that's your only condition is, hey, don't compete against us, then that compensation will be included in their income immediately. Okay, let's talk about FICA taxes, Social Security and Medicare. So on an account balance plan, meaning where the employee has an actual account with a balance in it, not a notional amount, but a physical amount, then FICA taxes are assessed on the amount that's credited to the employee's account. It's kind of akin to a funded, unfunded. A non-account balance plan, the FICA taxes are delayed until what's called the resolution date. And it's a little bit different than the risk of substantial forfeiture. So the resolution date is the first date in which the amount is reasonably ascertainable. So for example, let's say that you have non-qualified deferred comp, and you have a 5-year, it vests in 5 years, but once it vests, it's paid out over 5 years. So in that example, the resolution date would be the vesting date at 5 years. Even though you don't get all 5 years of payment at that point, all the FICA taxes would be due upon that date, because you could reasonably ascertain the value of what the payments are going to be. I mean, you know what they're going to be because it's contractual. And so at that point, the FICA taxes are due and payable. A little bit confusing, but that's the way it works. Yeah, stock options, they've fallen out of favor recently. Most companies are issuing restricted stock units, and the phantom stock that you can do under a non-qualified plan is a really good substitute for that. Okay, let's jump into an actual sample plan. So as I mentioned, I selected the phantom stock as the sample plan. It's one that I think, there are several of you out there that probably either are considering this. I know I talked to some people in Maui. There's a couple people out there that actually have these plans, and they can be a really good way for employees to benefit in the company. I don't have it in the slideshow here, but there's a whole nother discussion on how to fund a phantom stock plan. One of the more common ways is to, when establishing a phantom stock plan, is to fund a life insurance policy on the employee, such that by the time they go to draw those benefits, you can either withdraw the cash balance, or if they pass away early, you have the life insurance policy to pay out the benefits. Typically on a phantom stock plan, on the death of the participant, you're going to want to pay the benefits out to the survivors. It's not required, but typically that's what you're going to want to do. So that's where the insurance policy comes in. The second thing is, eventually, everybody's going to die, and so the company, that way they can recoup part of the cost of the phantom stock plan. That's typically used when it's a retirement type plan. If you have a 30-year-old that you want to retain for 5 years, and you have a 5-year vest and a payout, it may be not the greatest strategy. But life insurance can be used, especially if you're trying to fund this as people get into older age. So there's a couple of examples we want to talk here. Number one is what we call an appreciation only plan. And this is where the benefit payment is the growth that's occurred on these notional values. And so here's the example. We have an employee's account. You give them 1,000 units valued at $25 each. And for this example, we're saying it's when the employee retires. If that account value is now worth $300,000, then, because you take the $25 times 1,000 units, that's $25,000. So at the time they were granted these 1,000 units, it was worth roughly $25,000. In the future, the company's grown, and now those 1,000 shares of that company are worth, the company's that 1,000 shares is now worth 300,000, and so the employee added, or was part of the addition of $275,000 of value, and so they get $275,000. Once again, you can set up how they get this. It can be paid out in a lump sum. It can be paid out over a number of years. A 5-year payout, 2-year payout, 10-year payout. We actually had one of these recently, not one that we set up, but a regular employee that worked for a company that had one. And they had something similar to this. They were on a 10-year payout, and the company, around year 3 or so, the business really was booming, and it was just sort of an annoyance, and they actually paid out the employee early, about 7 years early. They gave him a lump sum for the whole amount. So the way you pay it out can be very flexible if you build that into your plan. The second type of phantom stock plan is what we call a full value plan. So this simply, you're paying the full value of the shares to the person when the vesting requirement is met. So not only do they get the $275,000 worth of appreciation in the value of the shares, but you're also paying the $25,000 of the initial value. And so they would get a distribution of $300,000, called a full value plan. The value of the shares plus any appreciation that they received. The next one is what we call a combination plan. This is, once again, typically used for a longer term plan where you're trying to retain people for a number of years. And a really neat way to structure this is maybe the first 10 years of an employee's career, you structure it as appreciation only. And so if they stay for so many years, but less than 10, and they leave, they get paid out just the appreciation value. And then, but if they stay past 10 years, you turn it into a full value plan where they get not only the appreciation, but the full value of their shares. So, and back to our little example here, employee who leaves during the first 10 years would receive the 275. An employee who stayed 10 years or longer would receive the 300,000. And so you can see, especially if you have someone, at year 8 or 9 thinking about leaving, it can be a real benefit to encourage them to continue to stay. Now, a lot of times too, this is not always just a one-time thing. What you may want to do, for example, in this example, we'll go back. Instead of giving 1,000 units in 1 year, or maybe you do it every year, it depends on the size of your company and how much this person makes, but you could give them a little bit every year. So you could give them, say, 100 units every year for 10 years so that each one has sort of a clock running on it. And this is the way your big companies do with restricted stock, is they grant restricted stock to their employees every year. And so every year they have to think really long and hard about, well, if I leave, I'm going to lose, the last 3 years of stock that I've been granted. And that's a really good way to retain people for the long term, is every year grant them some stock. Now, with a phantom stock plan, you have to be careful. Of course, because you're not giving them actual shares, you can give away literally as many as you want. You just have to make sure that you're going to be able to fund this plan. And so obviously you want to keep track of the restrictions and the payouts, what people would get. But one of the benefits if you have an appreciation only plan is if the business is valued at 10 million when you grant it to them and they retire and it's worth 10 million, well, guess what? The appreciation plan, you pay them nothing because it didn't go up in value. So there's sort of a built-in safety mechanism, but you don't want to give away all the equity. Well, maybe you do, but typically you're not going to want to give away all the equity in your company for one of these type plans. Okay, so that is the sample plan, and that is the end of the briefing here on non-qualified deferred compensation. Jen, do we have any questions from the audience?
We don't have any questions right now. You might
Okay.
want to seconds or something, but
Okay. Well, let me just kind of summarize. One of the couple of things on this. One, the plan does have to be written. It doesn't have to be overly fancy. Of course, your attorney may differ with me on that. But it does have to be written, and it can take a wide variety of formats. As I've said, there's some basic rules that you have to follow, but that's why we kind of call it the Wild West of pension plan design, is because literally whatever you can think of can probably be implemented.
do you want to switch to the last slide just in case anyone does have any questions that they can contact us?
Sure. Yep. If you have any questions, you know where to find me. Here's our email that you can reach out. And that concludes the 5-part series on small business pensions. For those of you that joined us for all of them, I hope you got a lot out of it. This is a huge area of benefit for you as being a business owner. If you have any questions at all, just grab me at one of the Maui events or shoot us an email. So I think that's
Thanks,
it for
David.
today.
Thanks a lot, David. Bye-bye, everyone.
Okay. Bye.